Hello, everyone. Welcome back to Insights Beats. Today, we're going to dive into the fascinating world of banking and explore how banks in India make money. Have you ever wondered what goes on behind the scenes at your local bank? Well, let's find out. To understand how a bank generates revenue, we first need to explore its sources of income. Indian banks have several key revenue streams. First, the primary source of revenue for banks is the interest they earn on loans and advances. Banks lend money to individuals and businesses, and they charge interest on these loans. Second, banks charge various fees and commissions for services such as ATM usage, account maintenance, and processing transactions. These fees contribute significantly to their income. Third, banks invest their customers' deposits in various financial instruments, such as government bonds and corporate securities. They earn income from the interest and dividends generated by these investments. Fourth, foreign exchange services. Many banks in India offer foreign exchange services, which involve buying and selling foreign currencies. They earn a profit from the spread between buying and selling rates. Now that we know where the money comes from, let's talk about the major costs that banks in India incur. First, interest expenses. Banks pay interest on the deposits they collect from customers. This is a significant cost because they need to provide a competitive interest rate to attract deposits. Second, operating expenses. Banks have substantial operating costs, including salaries for their employees, rent for branches and offices, and technology infrastructure expenses. Third, provision for bad loans. Banks must set aside a portion of their income to cover potential losses from bad loans. This is known as the provision for non-performing assets, NPAs. Hence, at a high level, money flows in as income and flows out as expense. Money flows into a bank from various sources, including interest income from loans, fees and commissions, investment returns, and deposits from customers. On the other side, money flows out of the bank to cover expenses like interest payments to depositors, operating costs, and provisions for bad loans. It's all about maintaining a balance between income and expenses, and there are important metrics that banks use to evaluate their financial health. One critical metric is the CASA ratio, which stands for current account and savings account ratio. This ratio represents the proportion of a bank's low-cost current and savings account deposits compared to its total deposits. Current and savings accounts generally pay lower interest rates to depositors, so a higher CASA ratio indicates that a bank can access cheaper funds. This can help reduce its interest expenses and boost profitability. Another key indicator is the net interest margin. NIM is the difference between the interest income a bank earns from its loans and the interest expenses it incurs on deposits and borrowings. A higher NIM indicates that a bank is earning more from its lending activities compared to what it pays out in interest, which is a positive sign for profitability. We also need to consider the provisions for bad loans. Banks set aside money to cover potential losses from loans that may not be repaid. This is essential to ensure the bank's financial stability and compliance with regulatory requirements. So, to summarize, banks strive to maintain a healthy balance by maximizing their CASA ratio, managing their NIM effectively, and prudently provisioning for bad loans. If they can achieve this balance, they are better positioned to generate profits and ensure the financial well-being of their customers and shareholders. So, there you have it. A brief overview of how banks make money and manage their finances. From interest income to fees and commissions, banks have diverse income sources, but they also have significant costs to manage. Remember, a stable and profitable banking sector is essential for a country's economic growth. If you found this video informative, don't forget to like, share, and subscribe to our channel for more exciting insights into the world of finance. Thank you for joining us today, and we'll see you in the next video.